Hello, and welcome to our weekly Understanding Markets webinar. We're recording this on the afternoon of Tuesday, the 5th of April. I'm Hellen Dalton, a Senior Investment Manager here at Cantor Fitzgerald, and I am once again joined by our Chief Investment Officer, David Beaton. David, we had the end of the quarter last week. I think it's fair to say it's one for the record books.
Good afternoon, Helen. Good afternoon, everyone who's listening in. Yes, it was a difficult quarter, to say the least. Bookended by kind of two differing events which caused significant market volatility. We started the year off with significant uncertainty about central bank monetary policy. We had the Fed pivot back in December, where they indicated that they were going to be more aggressive in their pace of interest rate hikes during the course of 2022. So that kind of destabilized risk assets at the start of the year. And then as we came into the quarter and into the latter half of the quarter, obviously we had the geopolitical incident in Ukraine, the invasion on the 24th of February, and very volatile trading post that. Significant sell-off, as we would have mentioned a few weeks ago on one of our earlier podcasts, but markets managed to regain some of their poise coming into the end of the quarter. But net, it was a tricky quarter for markets. I mean, on average, on a global basis, equities were down about 5.1%. But as always with these type of average figures, there was great divergence in the regional performances. So, you know, the likes of Europe, which obviously is in the front line of what's going on in Ukraine and Russia, down on average about 8 or 9%, whereas US markets down less aggressively, down by about 2.5%. So certainly a volatile quarter for equities.
Indeed, and you touched on the Fed and some of the news that started the year. We saw last week the US yield curve inverted very briefly last week, which of course reverberated through financial markets. Why did it have such an effect on markets?
Well, maybe as a starting point before I get into that, I suppose the other critical area of weakness during the course of the first quarter was the bond market. Bond markets had their worst quarter in history during the first quarter, with the Barclays Global Aggregate Bond Index, which would be a good benchmark index for global bonds, down over 5%, which for assets which are perceived to be safe haven assets is a significant drawdown. And it really is related to what you were saying there, Helen, in relation to the more hawkish tones coming out from central banks, but particularly the US Federal Reserve. At the start of the year, markets had probably priced in 2 to 3 interest rate hikes out of the US this year, but they're now pricing in as many as 7 in total. We've already had one at the March 16th meeting, and the Fed have indicated that they could easily move interest rates higher at the next 6 meetings for the rest of this year. And that's caused bond yields, particularly at the short end of the market, to move aggressively higher. And just by way of example, the yield on the US 2-year Treasury note at the start of the year, the 1st of February, was around 75 basis points, so 0.75%. As of this morning, it's that yield is now at 2.37%. So the short end of the market has really moved aggressively to price in a much more aggressive US Federal Reserve. The longer end of the market is showing signs of concern that the Fed might be too aggressive in their tightening policy, and bond yields there have actually come in a little bit in recent weeks. So what's happened now is, and this is where we attempt to explain the theory of yield inversion. The yield curve is deemed to be inverted when shorter dated bonds are yielding more than longer dated bonds. Traditionally, and I'm not saying that this is going to be the case this time around, but traditionally the yield curve inversion has been a predictor for some form of recessionary pressure in economies at some point going forward. The timing of that can be as short as 6 to 8 months, or it can be as long as a year to a year and a half. So the markets are still trying to digest whether this is a real kind of recessionary signal that the bond market is sending out, or as some commentators and ourselves included would be indicating that the bond market has been distorted significantly over the last 5, 6, 7 years by the sheer amount of buying of government bonds that central banks have been doing. And what that has done, and that has suppressed longer dated yields. So you could argue that a 2.5% yield on the US 10-year probably is artificially low. So it's not a foregone conclusion that we will have a recession sometime in the future, but it is something that clients should be keeping a close eye on to see how much the curve inverts by.
Really insightful. Thanks very much, David. I think it's also important to mention that it was an intraday inversion. It wasn't even, whereas in the past it's been an overnight event, whereas this time around it was really just very, very brief. Turning to the wider Cantor group, I know you're in constant discussion with our colleagues in the London office and in the New York office. And I spotted that you'd mentioned something about what our New York office were talking about there in the Weekly Trader.
Yeah, I mean, just for clarity for our clients, I mean, our own investment team in Merry Investment Managers still have a positive view on risk assets going out to the medium to longer term. But that doesn't dismiss the fact that there are short-term risks and headwinds which are still present for markets. And this is something that our team in New York, who probably would take a shorter term view given the nature of the business that they're conducting, would have compared to our colleagues in Marion. But the US team are cautious in relation to the whole geopolitical risk that's posed for markets at the moment in relation to kind of growth outlook, also as well how aggressive the Fed will be and what that might mean for consumer discretionary spending in the US. Now they are looking at it very much with a US hat on. Bear in mind the US consumer accounts for about 70% of US GDP. So any signs of a slowdown in consumer spending because of a tighter Fed policy, again, is something to be mindful of. We've seen a big move up in recent weeks, along with the move up higher in yields in US mortgage rates. We're seeing fewer levels of refinancing of houses in the US. And bear in mind, US householders typically would be more active in refinancing their mortgages than, say, their Irish counterparts would be. They tend to use their households, I like to use the phrase, as their own personal ATM. They refinance, take out some excess capital, and that allows them to continue spending on other discretionary areas. So our team in New York are just mindful of the potential impact of higher rates on shorter term consumer spending.
Yes, thank you so much. I get the sense in terms of what we're seeing with markets that there's been a bit of a selling the rally rather than buying the dip phase that we've been seeing whilst the volatility has been playing up.
Well, I think, I'm not sure whether it's selling the rally. I think you look at the market in total from how it performed during the quarter. Yes, markets were down anything 8 or 9% in Europe, but bear in mind they were down about that much before the Ukraine crisis emerged. So while there was declines of as much as 20-odd% in the DAX, for instance, at one point in time at the worst in early March, the war risk, if you want to call it that, has been removed from equity markets. So we're now trading at levels to the downside that were in place before the invasion happened. So in my opinion, I think the central banks are still pivotal to the overall direction of equity markets. But that's not dismissing the fact that in the very short term, clearly the worsening situation in Ukraine is going to cause difficulties and uncertainties for markets. You have the risk now. We've seen extreme volatility in commodity prices, so which we touched on before. We now have a situation where, with the latest atrocities that were revealed over the last 24, 48 hours, that Europe are looking at some sort of sanctions, or that will include removing Russian energy supplies from Europe. Now, that has the potential to cause further volatility in the commodity space. I think this is a really critical juncture for the EU. They've been very unified heretofore in their sanctions policies against Russia. But now that the critical area of energy, on which France, Germany in particular, are so dependent, is coming as a potential sanction, we are starting to see the first signs of division in the unity that has been kind of very prevalent in this whole crisis. So I think we're going to get headline-driven news in relation to areas such as that will continue to kind of keep markets contained in around these levels in the short term.
Okay, David, thank you very much. Very insightful as always. And given the ongoing events in Ukraine and the continued news coming out of the region and the knock-on effect it's been having in Europe and the wider world, Cantor Fitzgerald has aimed to keep you up to date with these weekly webinars and the effect it has on markets. So whilst the situation continues to remain fluid, market volatility has eased back, as David has alluded to. So we just wanted to say the Cantor team remains very committed to keeping you updated, and therefore we will be back with a scheduled update on the 19th of April. And in the meantime, I would like to thank you very much for tuning in, and I would encourage you to get in touch with your broker if you do have any questions. Many thanks.